£50 a month. That is £1.64 a day, less than a coffee. And most people will tell you it is not enough to bother investing. They are wrong, because £50 a month, left alone for long enough, turns into something that will genuinely change your life. Today I am going to show you exactly how much it becomes year by year, and the exact moment when everything changes. Let us start with the number that makes people give up before they begin. You invest £50 a month for an entire year, 12 months of discipline, and at the end of that year, assuming a 7% average annual return, your portfolio is worth £620. You put in 600, the market gave you 20. That is it, 20 quid. And honestly, that is the moment where most people quit. They look at that £20 and think, what is the point? Here is the point, that £20 is not the reward, it is the seed, because compound interest does not work in a straight line. It works in a curve, and the curve starts slow, painfully slow, but it does not stay slow. After 5 years of £50 a month, you have put in £3,000. Your portfolio is worth £3,580, so the market has added £580 on top of what you contributed. Not life-changing yet. But something has started to shift. In year 5 alone, your investments earned £219. That is almost 4 months of contributions generated by the money itself. Your money is starting to work. After 10 years, you've contributed £6,000. Your portfolio is worth £8,654. The market has added £2,654. More than a third of your total portfolio is now pure growth, money you never earned, never saved, never transferred. It just appeared because you left your money alone and let compounding do what compounding does. But here is where it gets interesting. Somewhere around year 11, something remarkable happens. Your investments earn more in a single year than you put in during that entire year. You contribute £600. Your portfolio generates £645 in returns. Read that again. Your money is now earning more than you're giving it. This is the moment everything changes. This is the crossover point. And from here, the gap only widens. If you're watching this and thinking about starting, this is the number to hold in your head. Not the £20 after year 1, not the £580 after year 5. The crossover. Year 11. That is when £50 a month stops being a savings habit and starts being an investment engine. Now, before we keep going with the numbers, if you have made it this far, you're clearly serious about getting your money working for you. If you're not subscribed yet, hit subscribe. I am building this channel specifically for UK beginners who want to start investing without the jargon and without needing thousands of pounds to begin. More videos like this are coming every week. Right, let us keep going, because after the crossover, the curve accelerates. After 15 years, you have put in £9,000. Your portfolio is worth £15,848. Nearly £7,000 of that is pure growth. Your money earned over £1,000 last year alone. You're contributing £50 a month, but your portfolio is growing by more than £80 a month on its own. After 20 years, you've contributed £12,000 total. Your portfolio is worth £26,046. More than half of your entire portfolio is now money you never put in, £14,000 of growth. And in year 20, your investments earned £1,734. That is nearly 3 times your annual contribution. Your £50 a month is almost irrelevant now compared to what the portfolio generates on its own. After 30 years, and this is the number that changes how you think about money forever, you have put in £18,000, £50 a month for 30 years, and your portfolio is worth £61,000. You contributed £18,000, compounding added £43,000. 70% of your final portfolio is money you never saved. It was created by time and patience and the simple decision to start. Now, I need to be honest about the assumptions here, because I am not going to hype you. These calculations use a 7% average annual return. That is roughly what a global index fund like the Vanguard FTSE All World has returned historically over long periods. It is not guaranteed. Markets go up and markets go down. Some years you will be up 15%. Some years you will be down 20%. The 7% is the long-term average, not a promise, but it is what the historical data shows over 20 and 30-year periods. And the longer your time horizon, the more reliable that average becomes. And here is the part that makes all of this even better if you're in the UK. If you invest your £50 a month inside a stocks and shares individual savings account, every single penny of that growth is completely tax-free. No capital gains tax, no dividend tax, nothing. The current ISA allowance is £20,000 per year, and you're putting in £600. You are nowhere near the limit. The entire £61,000, after 30 years, all yours, no tax. You do not need to pick stocks. You do not need to watch the markets. You do not need to know what a price-to-earnings ratio is. You open a stocks and shares individual savings account, or ISA, with a platform like Trading 212, Invest Engine, or Vanguard. You pick a global index fund. You set up a £50 monthly direct debit, and you leave it alone. That is the entire strategy. The hardest part is not the investing, it is the waiting. It is looking at £20 of growth after year one and choosing to keep going. It is watching your portfolio drop 15% in a bad year and choosing not to sell. It is trusting the maths when the maths feels too slow. But the maths does not lie. £50 a month, left alone, turns into £61,000. And the person who starts today is always ahead of the person who waits for the perfect moment. So here is what I want you to do. If you're not investing yet, start this month. £50, one index fund, one ISA. That is it. And if you are already investing, drop a comment below and tell me what you're putting your £50 into. If you are finding these videos useful, remember to like and subscribe. It really helps the channel reach more people.